Well, the US economy, it's going through some tough times, and everyone's paying close attention to what the Federal Reserve is doing. People are really talking about the Fed's decisions on interest rates, even at the dinner table. Some experts are saying that raising rates could be really bad for the economy, while others think the Fed doesn't have much choice and just has to do it because of inflation. You can see how these decisions are affecting banks and financial institutions with all the chaos in the markets right now. This had a direct impact on companies like SVB, among other things, and you can see how this would create a domino effect, one after the other after the other. You came here for the truth. Today I want to show you what's been happening, and I think it's important to start with this. If the Fed can't keep rates high, if they can't keep raising as they need be, and we have persistently high inflation, we are in a very, very, very dire situation. So that's really what a lot of analysts, CFOs, and all these different high-level individuals are saying, that we do have a problem here, and that is inflation is high. We also have another issue, and that is banks are collapsing. And so they have to manage these two things. And we could say here that the Federal Reserve only wants to help their friends at the banks. And we know that. They'll bail out certain banks, and they'll be able to, persistently do this because, as they've said before, they've got an unlimited printing press. So it's no problem. But of course, there are issues here. And you've got to understand this at a deeper level. We'll get into that today. Look at this. If they stop and reverse rate hikes, that could cause markets to believe that they're not fighting inflation when inflation is still a problem, giving you higher mortgage rates and funding costs for corporations and just a tighter vice on the economy. What I've seen here is, if you're watching my previous video, you probably saw it already, but the Federal Reserve increased interest rates by another quarter point, so 0.25%. And that's important because you look at how tight things are, and the expectation here is that how are they going to get around this? How are they going to keep tight at the same time that you've got problems? But I point to what's happening in the markets. Yes, the direct impact day one was not very good, but you got to think about this. If you look at what's happening, ultimately the stock market is relatively close to its high point. You've got some companies that are doing terribly, of course, but in general, it's not that far off from its all-time high. So we got to break that down. You look at what's happening with housing prices. Yeah, they've come down a little bit. Some places they come down a lot, but that's from the extreme peak. The Federal Reserve needs to keep interest rates at these elevated levels. We'll call it elevated, okay, 5%, for a considerable period of time in order to actually stop inflation. I'm not talking about CPI inflation. I'm not talking about core PCE inflation. No, I'm talking about actual inflation. And that can be measured in different ways, but just look at rent, look at your mortgages. Shelter is extremely expensive, and that's driving a lot of their own metrics of inflation. Even though they do it in a way which it kind of, squeezes it down and always makes it less than it really is, that's really important. And so they have to keep it up, or else they're not going to be able to get inflation down. That's a matter of fact. And so they're caught in this mode right here of we need to be really tough, but we also have to do a lot. We're expanding the balance sheets considerably and all these different things. So let's look at the next aspect, okay? Because for a lot of people, I think this is not understood. Let's just break it down. There's a lot of criticism and controversy about what the Fed is doing, like how they are handling economic challenges. And then there's the fact that our monetary system seems to be getting worse, which has experts worried about inflation, and the value of our money is clearly, you see it at the store, the supermarket, it's going down. Policymakers are trying to figure out how to stabilize everything and make sure that bank deposits are safe, but the future of the US economy is still up in the air. That's why Janet Yellen came out and tried to initially calm the markets. Don't worry, we're going to handle this. But at the same time, then came back and said, well, not every deposit's going to get taken care of. It's really in flux. So they got to decide on what they officially want to say, put a statement out, and that will calm the markets down. The markets are always ready to buy. Okay, they're always going for calls, not necessarily puts. They really want that. So I want to show you more about this. How the Fed's 2008 mortgage experiment fueled today's housing crisis. And there's a lot to this. I think it's, I'm not going to get into it all. Obviously, I talked about it in my first book, and it's important. It's important to see it because, as they say here, from 1913 until 2008, the Fed owned 0 mortgage-backed securities. While the Fed's monetary policy decisions still impact the conditions in the housing and mortgage markets, they did so indirectly through the influence of the Fed's purchases and sales of Treasury securities they had on market interest rates. So they would go into the markets and they would do their thing, but ultimately they weren't buying the mortgage-backed securities. And then in 2008 and beyond, after that financial crisis, they started calling these things toxic assets. They said toxic because nobody else wanted to buy it. So the Federal Reserve said, temporarily, we're going to go in there, we're going to buy up this garbage. We know it's garbage, but then it's going to be able to sort of, wean itself off. And what has happened here? The Federal Reserve, even in 2020, when real estate prices shot through the roof and in many areas doubled during that period, the Federal Reserve said, I got an idea. We see the fire over there. We're going to push away the firefighters. Don't go there. We're going to take some gasoline and we're going to pour it on top, and that's going to resolve the crisis. Yeah, that's what they did. Believe it or not. They were buying mortgage-backed securities in a time that's to support the market. Buying mortgage-backed securities, creating more inflation for you, and doing so at a time in which it made absolutely no sense. There was nothing wrong with that market at all. You can make an argument for the treasuries. I would disagree with it, but treasuries is one thing. Mortgage-backed securities? Are you kidding me? Now the Federal Reserve can't drop them. They claim, at least in their statement, if you watch the previous video to this one, they claim that they are going to continue to wean off treasuries and the mortgage-backed securities. Okay, but what they're doing is really signaling that they are going to support the market. If they don't support the market, and clearly nobody wants to touch these things, the SVB crisis in part was because of that, who's going to buy it? You're going to have a big problem in real estate. Watch out. Okay, and we have this. The Fed has tightened its monetary policy so quickly, banks across the US have more than $600 billion in unrealized losses in their bond portfolios. This is a pretty major problem because that $600 billion is ultimately your money. And it's not like the Fed doesn't have access to this information. After all, the Fed supervises nearly every bank in the financial system. And yet last week, Fed chairman completely rejected the risk, telling worried senators flat out that nothing about the data suggests to me that we've tightened too much. And they're looking at different metrics, obviously. But when you see it, to me, just shows us that we are in a very different world today. Very different. And so I really do worry about this because many people are just overexposed, indebted, and they believe that, hey, they're going to just turn on the printing presses and everything's going to go up. That is a possibility, but we're not quite there yet. And so we're at an inflection point. You could have the markets just fall crazily tomorrow and you lose a lot because of this. You got to be very careful. If this is, for instance, I just was conversing with one of my subscribers today asking, what do I do about real estate? Should I buy a home? Well, if it's your own personal residence, you can't always try and time things, okay? If you can afford the payments, if you think you're okay with it, it's a personal residence, it's a different story. An investment property, that's a big one, okay? Because if the Federal Reserve is going to keep interest rates real high, I'd be very careful. I would be very careful about this, okay? Now, I do think they're going to turn on the printers, and I think they're going to devalue that currency to the ground. But watch out. We're still at that inflection point, okay? Things are only getting harder for the Fed. We should be thankful that the past 2 weeks of banking stress did not happen sooner. This is in part what I've been talking about here. I don't want to beat a dead horse about it. What you can see that what analysts want, essentially what this is talking about here, what analysts want, what the banks want, what everybody wants is for the Treasury, the FDIC, the government, everybody to come out, Fed, everybody to say, we're going to protect all depositors. If they get that word all or something close to that, then everything's all good. If they say, no, we're not going to protect all depositors, suddenly there's a lot of turmoil because for some reason, they weren't worried about that before. I mean, it's just strange if you ask me. But anyway, the Federal Reserve has been a hot topic. People are really critical of it, and for good reason. The suggestion is that the whole housing crisis that we're facing today has a lot to do with the Fed's mortgage experiment back in 2008. And then there's the debate on how the Fed deals with economic troubles. Some people believe that if the Fed doesn't act fast and bold, it'll just make things worse for the economy. There are even people who think that the Fed has basically taken over American democracy because of the huge impact its policies have on politics and the economy. I think that's pretty clear. Now, the Fed's got some big issues to deal with. They've got inflation, they've got a growing balance sheet. Experts like Rogoff are saying it's not going to get easier for them. And with all of the attention on their balance sheet and deposits that are coming in, I've shown you before, it's really up in the air about how they're going to handle it. And that's why I say we're at this inflection point here and now. So I hope this was informative to you. If you want, you've got to be able to join the Insiders. The Insiders is my email list, totally free, where I will email you the first video of the day. And you're going to get that, and you're going to be able to get this. Why? Why do you need it through your email? It's because chances are you're not going to get it from your recommendations. And so you get the email of the day. It's nothing like no spam, no garbage in there. I email you the video of the day because I lost a lot of traction on the videos. So I'm trying to get that back. So I'm investing into the Money GPS again, putting more money in, trying to get you to, basically be in front of you. And that's a simple matter of fact, okay? themoneygps.com, scroll down to the bottom, fill in your name and email, and I'll send those directly to you every day so that we can connect directly. Take care.